Hello, everybody, and welcome to the new week. My name is Eno Eteng of Investing Cube. I'm here to talk about really what we're going to be expecting this week. And the major news for the week actually is going to come from the United Kingdom. Tomorrow we have the set of employment data, and on Wednesday, 19th August, we'll have the UK CPI report, which is going to be a report that will shape market expectations as to what the BOE's interest rate policy is going to be like heading towards the end of the year. So let's head over to the economic calendar right now, where we see that the market is actually expecting the Clement count change to come in at 11.2K, with the priors already coming in at 6.7K. And the average earnings index is expected to drop from 4.3% to 4.0%, while the unemployment rate is expected to drop from 4.9% to 4.8%. Now, basically, what the expectations indicate is that the market expects a deterioration of the employment conditions in the United Kingdom. Whenever you have an increase in the claimant count rate, it simply means there are more unemployed people seeking for first time unemployment benefits. So that means that a lot of people are losing their jobs more than before. So if you had a claimant count rate of 6.7K for the month of June, and you're now getting a claimant count rate expectation of 11.2K in the month of July, that means that there's a deterioration in the UK employment conditions. The same thing goes for the average earnings index, which is expected to drop from 4.3% to 4.0%. Average earnings is an indication of how much workers are earning, okay, in the United Kingdom in a space of 3 months. So the index number that is released usually covers a quarter, okay, even though it's released monthly, okay, it's typically released about 45 days after the month ends. So it's measure the change in the price business and governments pay for labor, including bonuses. So if you see this index print going down, it indicates a deterioration. Okay, it means that workers are not earning as much as they were earning previously. So typically speaking, if you have a situation whereby the consensus is for an increase in the claimant count change and a reduction in the average earnings index, then that means that the market is actually expecting the employment sector in the United Kingdom to suffer a bit of a deterioration. Okay, so let's go to the charts. Typically, if you want to trade this, the two currency pairs of choice are the GBPJPY and the GBPUSD. Okay, so let's take a look at the first currency pair, which is the GBPJPY. So right here, we see that, of course, basically the yen had gained some strength over the last 2 weeks, principally because of the 30th July intervention that was conducted by the Japanese financial authorities. Okay, and that sent the GBP down from 218.58 all the way down to this support level right here at 209.51. Now, throughout last week, we saw the British pound gaining ground, okay, and recovering most of the ground it lost to that intervention. So right now, the price is testing the 216.03 resistance level, which was a previous high that was seen in April of this year. Okay, so typically, if you're going to see a UK employment data print that supports the British pound, you would expect this resistance to give way and for the GBPJPY to continue its recovery all the way to 217.23 or even to retest the 30th July intervention resistance level at 218.58. However, if the data prints are bad for the British pound, you're going to see this price level here serving as a strong resistance that rejects this uptick. And we're going to see a pullback that's going to retest the 214.62 support. And if that support doesn't hold, then we could see price going all the way down to retest the 18th and 25th July lows at 212.61 right here. Okay, so these are the price levels that you need to watch out for. Now, I need to state that, of course, because there are multiple parameters that are released, okay, as part of the UK employment report, you need to see that those parameters align. So if you're looking for data prints that support the British pound, you need to see a lower than expected claimant count change and a higher than expected average earnings index. Okay. Also, if you're looking for data on which to sell the British pound, you would expect the claimant count rate to rise more than the market consensus, and also for the average earnings index to be lower than the market prediction of 4.0%. So you need to have the data sets to align in order to produce a tradable result. Okay. Now let's go to the GBPUSD, where we can see that the pair is right now on the verge of a breakout of the 1.3518 resistance level, which served as a previous high of 26 May. And also, this was also a previous support, for the on 5th of February. But that support at that level was at that time was broken, and right now there's been a lot of back and forth around several support and resistance levels, as the pair has mostly been trading within the range in the medium term, ordered by 1.3173 below and 1.3663 above. Okay, so right now within this price band, there are several resistance and support levels, and the last resistance before we hit the upper band of that range has been violated. Okay, we need to see a daily close above that level and above the 14th July high at 1.3444 in order to confirm the breakout above 1.3518, and this would now make a case for the price to advance towards this high right here, the 30th April high at 1.3663. This is the upper band of the medium term price range. Okay, and what we will need to see again is to see the British pound receiving support from a lower than expected claimant count change and a higher than expected average earnings index. So if we see that tomorrow, then we're going to probably see the British pound inching its way up to retest this resistance point. But if the news doesn't support the British pound, then we could see this support immediately coming under threat, and it could really give way, and then we could see a retest of 1.3387 right here, which is a previous low seen in January of this year. And if that level doesn't hold, then we could see the retest of this low right here, which is the low of 28 July right here at 1.3283. That's the next support level after the 1.3387 support. So if this support and these support levels are degraded, 1.3283 becomes the next focus to the downside for the sellers. Okay, so basically that's one of the most important macroeconomic events that's going to schedule for this week. It's going to start off tomorrow with the UK employment data, and then of course later in the week, and that's on Wednesday, we're going to see the UK inflation report hitting the markets on 19th of August. Now, basically, the markets are predicting that inflation is going to increase from 2.6% year on year to 2.9% year on year. And if this plays out as expected, then we're going to see the Bank of England maintaining the current interest rates for quite a while, which is a more hawkish expectation than the markets are expecting. And that would, of course, support the advance of the British pound. But if we see a significant cooling of inflation below 2.9% and even probably below the prior number of 2.6%, then this would make a case for the Bank of England to ease interest rates. Of course, this has to be looked at in context of the employment data that's going to be released tomorrow. So basically, what we're seeing is that the Bank of England is actually looking at the employment situation and also looking at the inflation situation. So if we see a deterioration in the labor conditions in the UK, and we also see significant cooling of UK inflation, then that will make a very strong case for the Bank of England to resume its easing pathway. But if that is not the case, then the Bank of England will prefer to maintain its cautious tone and keep interest rates where they are, which of course is a more hawkish expectation. So we might do another video towards the end of the week in which we're going to look at the various data sets that have been released out of the UK and now use it to make some sense as to what we expect the Bank of England to do in the next interest rate decision. And that's going to also determine what the pathway towards the end of the year is going to be. So thank you for tuning in to this Monday's look at the markets, and we hope you'll be able to take the information and make some profits along the way. Thank you.